Hey everyone, my name is Emerson Pierce, and for our group's market analysis of COVID-19, we decided to do it from the real estate company executive, and we kind of broke it up into commercial real estate, residential real estate, and then financing at the end. So to start off with commercial real estate, the commercial real estate industry is getting clobbered right now and expected to get worse before it gets better. Commercial real estate development is also getting hurt really bad right now as supply chains are getting turned into disarray. And this is causing developments to either have to stall or completely stop their operations right now. Some of the sectors of commercial real estate hit the hardest include hotels, restaurants, bars, and other entertainment retail. And if you're in a state such as Florida that relies on tourism more heavily than other states, this can kind of amplify the effects as less people will be there in general in the hotels, restaurants, bars, spending money at these places. And then as a commercial real estate company executive, it really depends on what you invest in or own, on how these effects of this pandemic are affecting you. So rental properties, for example, tenants are unable to pay rent right now, and you're not going to be able to pay possibly your mortgages. Same with retail. Stores and restaurants are being forced to shut down or operate with limited operations right now, which is causing them to not bring as much income in and pay their rent. For example, Staples, one of the biggest office suppliers in the country right now, already said that they won't be able to pay their April rent. So this can seriously affect you if you own that property because with these tenants not being able to pay you their rent, you will probably default on your mortgages. Um, Office as well. Right now, a lot of offices are empty, which could hurt companies' ability to generate income right now and pay their rent as well. And then it could be a long-term effect for them as um, maybe some people start to realize that working from home, you can still be productive and efficient. And with people getting laid off and companies going out of business, there's going to be less need of office space in the future. So that could be more of a long-term effect for commercial real estate owners in the office sector. So these are some graphs here that go over the vacancy rates and how they're expected to rise. I believe this is from Moody's, and you can see multifamily, industrial, and retail are all expected to have a huge rise up until 2021. So the effects of this could be 2 years like really hard hit for these sectors of commercial real estate. Retail getting up to 14.6%, industrial 14.3%, office 21.4%. And then multifamily is actually relatively safe, only going up to 6.6, but that still is an increase. But that does seem to be the safest sector right now. Is people are going to need a place to live no matter what. So the recommendations we made is if you're a company executive right now, and you have enough liquid cash, now is a good time to invest in some of the hardest hit sectors. So like I said before, hotels, retail, mortgage-backed securities, and investment firms like Blackstone Group and Starwood Capital Group have said that they're also kind of eyeing these properties. So I think that if companies like that are eyeing these properties, it could be a good investment for anyone right now. Uh, so and then COVID-19 has caused kind of a sudden shutdown, whereas the financial crisis was a little bit more delayed. So I think that if you are wanting to invest in some properties, you need to act fast, as a lot of these people like properties will probably go up for sale relatively soon as people start to default on mortgages and can't make ends meet. And then we talk about financing later on, but you should definitely leverage these purchases with the ultra low financing rates available. So some of the strengths that I thought we had with the commercial real estate sector information we got was that with coronavirus being kind of the center of attention for everyone right now, there were a lot of reliable sources to get information from, and with people not really working right now, there's really only that to rely on. So everyone's kind of looking there, and I think there's a lot of sources out there right now. And we were able to find real world examples such as Staples stating that they wouldn't be able to pay their rent, and then also the capital group's recommendations, kind of proving that those could be good recommendations. And then accurate financing information. We were able to get these from banks and things like that, which we'll talk about a little bit later on too. But that was very accurate. So some of the weaknesses that I thought we had was that all these are projections and no one really knows what's going on. So you kind of got to take everything with a grain of salt, which kind of goes to the second point. I mean, this is the first time the modern world has dealt with a pandemic like this. So no one really knows what's going to happen. And you got to kind of just take everything with a grain of salt, like I said. And then a lot of this, the information is so new. It just happened in the last month that a lot of it is not complete right now. And a lot of commercial real estate companies and executives haven't really reported all the information because they don't really know everything yet. And so with that, I will go ahead and pass it on to the next person in our group.
My name is Michael Kohlberg, and I will be talking about the effect that COVID-19 has had on the United States housing market and will possibly continue to have in the future. The market for house sellers has drastically decreased since March of this year and the initial outbreak of COVID-19 in the United States. In the last week of March alone, over 28,000 homes were taken off the market, which is an astonishing 148% increase from the same week last year. While there's been a significant increase in listings being taken down, there's also a dramatic drop in houses being put up for sale. Data from Redfin has new listings being down 33% from the first week of April. And this chart shows the numbers clearly in bigger cities around the United States. This can be attributed to many possibilities. Also, residential homes are dropping in price because there's a growing concern about tighter lending conditions for non-conforming loans. Buyers of residential real estate with debt-to-income ratios around 45% are having a very difficult time acquiring loans, which is forcing them to either wait to buy a home or purchase a cheaper one. Currently, the residential real estate market in South Carolina is going strong, and according to news in Fort Mill, there are still low interest rates. Buyers are out there pre-approved and ready to buy, and there's low inventory. One fear that is easy to pin is the remembrance of the housing market in 2008. And while it seems that will not happen again with COVID-19, people are still in fear of buying and then having the prices drop again. Another very simple reason is the actual virus itself and how fast it's spreading. A lot of selling your house has to do with open houses, and no one really wants to let people into their house walk around for fear of getting the virus. And then if they're unable to do this, the selling market will drop fast. As a real estate executive, I would be careful about buying much residential property during a time like this. The possibility of the market going down even more as the next few weeks go on is high, and along with that, many people will not be able to pay their rent. This could possibly lead to landlords looking to sell their properties at lower values than they otherwise would have wanted to in order to have a source of income. According to the Charlotte Observer, real estate agents have seen buyers put purchases on hold and sellers' homes have languished on the market. The best thing that a real estate executive can do at a time like this is to keep assets in a liquid form so they can be ready to buy properties if the above situation proves to be true. This presentation has some clear strengths that we were able to take advantage of. The first being that in this day and age, we have access to an incredible amount of data from the real estate network. And this allows us to use the hard numbers given to us to form thoughts and ideas about the market. Another strength is that we can look back to the 2008 housing market crash and learn from this and hopefully not repeat it. But some of the weaknesses include our inability to read the future, and we just have no way to possibly know exactly what's going to happen. And we can predict it, but we never know if those are going to come true. And then also, while we see strong correlations to COVID-19 and the housing market drop, there are other possible reasons for the housing market to be switching around like it is.
Hi, my name is Ben Capinos, and I'm going to be talking about interest rates. So interest rates on a 30-year fixed rate mortgage are almost at an all-time low. And the reason for this is because of two things. One, the lack of demand for funds, which is clear because no one is buying a house or taking out a mortgage during this pandemic. And two, the Fed has dropped the federal funds rate by nearly 150 basis points. And this means that lending institutions can lend money at a much lower rate. So my advice to a real estate executive would be to capitalize on these interest rates because it would create more cash flow for future periods and will reduce interest rate risk for the investor. So this is a great graph generated by Freddie Mac, and it shows that during the Great Recession of 2008, 2009, interest rates were almost double what they are today. So the reason that this is because during the Great Recession, it was caused in the real estate industry, and it was built up on all these bad loans, and everyone wanted to take out money for real estate. and it jacked interest rates up. But today, it was not caused in a specific industry. This recession was caused by a virus, which caused everything to shut down almost simultaneously, which really just lowered demand for funds and shows why interest rates are so low today. So my advice to a real estate executive would be to take advantage of this clear investment opportunity. If you invest at a current fixed rate of 3.33%, it will completely change the feasibility of your investment. Also, a real estate executive should definitely attempt to refinance or modify all outstanding loans on their properties. Even a loan taken out a year ago on a property could be an entire point lower today if they refinance. And lastly, this is definitely more beneficial to residential investors because mortgages are much more common in the residential industry as opposed to the commercial industry.
The economic crash that has been caused by COVID-19 has no doubt caused some financial distress for most, if not everyone. However, this economic crash has led to an opportunity for some to gain a financial advantage. One result from the chaos is close to all-time low interest rates on mortgages. Many people who are currently under a mortgage loan can use this opportunity to lower their current interest rate by refinancing. If someone is struggling to pay their mortgage payments, refinancing for the remaining balance correctly can allow them to make smaller payments because of the lower interest rate. Someone who could use some extra cash on hand can refinance to a term with a higher balance than what's remaining. The lower interest rate can result in the increase of cash on hand for a similar or same monthly payment as they currently pay. This basically means they get more cash up front to spend in the present when it's most valuable and don't have to pay any more on their monthly mortgage. This will allow for one to spend money elsewhere, reinvesting in other opportunities while everything is cheap, making up for risky cash inflows as more and more people cannot pay their bills or anything else that's now affordable. And the strengths of this report, in summary, are the obvious benefits or opportunities financially, from needed cash on hand, more affordable monthly payments, to the ability to obtain a low interest rate that can stay that way even as the market rates will rise in the future. These opportunities provide one the chance to gain a financial advantage during an economically difficult time. And as the economy turns back around in the future and you secure more cash inflows, you can even have the opportunity to prepay your loan off and stop paying interest payments. There are also weaknesses, of course, and I'll explain those too. For instance, there are factors that are sometimes present in loan agreements, like closing costs, origination fees, and prepayment fees, amongst others, that go into a refinancing decision that can affect whether it's worth doing. Understanding and calculating these potential costs into the decision can be complex for an ordinary investor. An uninformed or lazy person may not know how to calculate this and may make a bad refinancing decision. Also, the financial advantage is only applicable to CPMs, or constant payment mortgages, where the set payment will be the same throughout the term of the loan. An adjustable rate mortgage, an ARM for short, may have lower initial interest rates that draw some people in, but once the market rates rise, those rates will rise too, and thus future payments will be higher. One more possible weakness is more of a negated benefit. If someone doesn't have the money in the future to prepay the loan off, then they could be stuck making interest payments for a longer period of time due to the higher balance that they refinance for. However, a lot of these weaknesses can be mitigated through due diligence and careful research or calculations, which means that this financial opportunity of refinancing your mortgage loan for a lower interest rate is definitely still worth pursuing.
Hello, my name is Bud Daniel, and I will be concluding our presentation about COVID-19 and how that affects real estate. So certainly these are the weirdest times that I think we've all been living in, especially in my generation. We've never experienced anything so altering or disorienting in our lives, but it especially applies to those who are handling the market every day, like a real estate executive. Right now we are in a recession. The stock markets are very volatile. The real estate market is very close behind it, even though our interest rates are staying low. It is being very, very odd, and we don't really know what's going to happen. And there could be even a depression that's going to be coming up soon. So what do we suggest as right now our team based off of what we've analyzed and read and concluded is our recommendation for long-term financial success would be to rely heavily on the built-up liquidity for your firm as a real estate executive, for yourself individually as an investor, or whatever it means to liquidate something and build up liquidity as well in order to invest it into what we would suggest as the commercial real estate realm. We have never seen a combination of these low interest rates and extremely volatile real estate distress at the same time. And so there is ample market room and opportunity for success. The two biggest things that I think that our team thinks it's going to take in order to have success in these crazy times is to do your research, know your stuff as a real estate executive, and then also to take action, to take risk, because it's very, very, very uncertain in our lifetime if you will get another opening or opportunity in the market like the one we have right now, because this is the craziest time we've ever had and the most disorienting time in regards to the market that we've had since 2008, since the 80s, since the Great Depression. So the two biggest things that we would suggest for the real estate executive practically would be to build up liquidity and to invest into the commercial realm. And then the intangibles that we would suggest to always keep on your mind is to make sure you know your stuff and to research, and then to not be afraid to take action once you've developed what you think is the correct investments or strategy to go about. Again, I'm Bud Daniel. Thank you so much for listening, and thank you for a great semester, Professor Shin. And yeah, that's it.